I am David Stein of Money for the Rest of Us. And in this video, I answer the question, why do stock prices increase or decrease? As a former institutional money manager, I spent a lot of time thinking about stocks and explaining stocks to my clients. And one of the questions, if we get down to the basics, is why do stocks go up or down in price? Well, stocks trade on an exchange. There's buyers and sellers, and they come together. And for every buyer of a stock, there's a seller. And the stock will go up or down in price based on the desire of the buyers. How willing do the buyers want to buy versus how willing do the sellers want to sell, and at what price? So you have a meeting of the minds in terms of who is buying and selling stocks. Well, who are those buyers and sellers? Well, first you have fundamental traders. And these are traditional buyers of stocks. They're researching companies, and they value companies based on the company's cash flow. What's their dividend stream in terms of the percent of profits that they're paying out? They also look at the cash flow growth. How fast will that cash flow grow over time? And based on the current cash flow in terms of dividends, what they believe it will grow, they decide they're willing to pay so much for that cash flow stream. And that's what's known as the multiple or price to earnings ratio. So you have the fundamental traders looking at that information. At the same time, you have algorithmic traders, essentially computers and bots that are looking for any relationship that they can find that suggests why a stock might go up or down in price. And most of the trades that occur in the stock market are by these algorithmic traders. So the vast majority of traders. The third constituency are passive investors. They just want to own a piece of the market overall, and they invest through exchange-traded funds or index funds. And they don't care what the stock is valued at. They just want to own a portion of that company. So those are the three constituents. They come together, and based on their desire to own a company or sell a company, that will influence the price, and particularly news that the company decides. If they make an announcement, that causes those fundamental investors to reassess either the cash flow growth and what they think it will be in the future. Now, there's some other trends going on in the stock market over the past decades. It's flat out smaller in terms of the number of listed companies. There's a study by Renee M. Stoltz of Ohio State University, and he found that the number of publicly traded companies in the U.S. was 7,000 in 1997, and it's down to about 3,600 companies today. Why are there less companies? Well, certainly there's been mergers and acquisitions, but a primary reason is smaller companies are less willing to do initial public offerings and be publicly traded. They want to stay private. They do that because they have trade secrets. They have intangible assets and other operational processes they just don't want to disclose in the public market. They don't want other competitors to steal what they're doing. And so they stay private for much longer. The other reason they stay private is these companies own more, as I said, intangible assets, research and development, other brand initiatives, and these are expensed as opposed to held on the balance sheets as assets. 30, 40 years ago, most companies had a lot of plant and equipment on their balance sheets. Now they have intangible assets, many of which are expensed, so they run through the income statement. And what Professor Stoltz found out is that companies are just less profitable, particularly smaller companies, because they're expensing so many intangible assets. And as a result, because they have lower profits, they think investors would be less willing to invest in them, so they stay private for longer. What that means for the overall stock market then is there's fewer companies, but there's also older companies. And those companies are more likely to buy back their stock in the stock market. And if you can buy back stock, then there's fewer shares outstanding, and that increases the company's earnings per share. And so we've had huge amount of buybacks, which has supported higher valuations for the U.S. stock market. So you have all these underlying trends. You have fewer companies out there. You have fewer shares available. You have more concentration of profits in these older companies. You have small companies being less willing to be publicly traded. They want to stay private. And at the same time, you have what actually drives the day-to-day volatility in the stock market. And it's the desires of these fundamental traders, whether they want to buy or sell, and as they reassess the fundamental attributes of the companies, the cash flow growth. You have algorithmic traders that are moving in and out, trading very, very quickly, many shares, just trying to find predictive relationships. And then you just have passive investors that own it just to be participating. They don't care what a company's worth. So that's why stocks go up and down, just these constituents making decisions whether to buy or sell. If you have any questions, you can go ahead and leave that in the comment. Thanks.